Now let's talk about interest-bearing note. So we all know that interest-bearing note is measured initially at face value or face amount. Also, on the subsequent measurement of this interest-bearing note is at net realizable value, where the face amount less all the payments made by the maker. All right. Now, I have an example here where the company received a face amount, a promissory note, an interest-bearing note face amount of 300,000 with an interest of 10%, and the interest date is December 31st annually. So meaning to say the maker will pay the company an interest every December 31st over the life of the promissory note. So the maturity date on this problem is January 1st of 2023. Let's say, for example, this is a lump sum payment of an interest-bearing note. So meaning to say the 300,000, the maker will pay the company at 300,000 on maturity date of January 1, 2023. Let's say, for example, the transactions occur on January 1 of 2020. So on the transaction date, our entry for this sale will be debit to notes receivable of 300,000 and credit to sales of 300,000. Annual interest date is December 31st. So on December 31st, our first year of interest, and our interest is based on our face amount. So our interest computations on this year is 300,000 times 10% times 1. 1 represents the 1 year. So if you are dealing with 6 months, then times 6 over 12 or 8 over 12. Now, 300,000 times 10% times 1 year is equal to 30,000. I did not memorize that. All right, so 30,000 that we receive on December 31st, our entry will be debit to cash of 30,000 and credit to interest income of 30,000. Our financial presentations for this notes receivable on December 31st of 2020, when the accountant prepares the financial statement of this notes receivable, will still be on 300,000. Second year of this promissory note, December, our interest will be the same computations. So we have 300,000 times 10% times 1. So we have 30,000 interest income on the second year of this interest-bearing note. All right, and we will have the same entry as the cash, debit to cash of 30,000 and credit to the interest income of 30,000. All right, the financial statement presentations of this notes receivable on December 31st, 2021 is the same. So our financial statement presentation will be notes receivable of 300,000. On our third year, 31st of 2022, our interest income will still be the same. So we have 300,000 times 10% times 1, and we have 30,000 of interest income. So your entry here is the same as your entry on those interest income. So we have debit to cash of 30,000 and credit to interest income of 30,000. All right, and your financial statement presentations on December 31st, 2022 is still the same. Notes receivable of 300,000. On January 1st, 2023, the maturity date, so our entry will be debit to cash of 300,000 and credit to the notes receivable of 300,000. All right, then we don't have to present anything on January 1st, 2023 because the notes receivable is now 0. All right, let's do another illustrations or another problems a little bit more complicated than the first one we did. So this is still interest-bearing note. The company sold a goods to a customer, and the customer gave a promissory note to the company or an interest-bearing note to the company with a face amount of 300,000, and the maker of the promissory note or the customer will pay a 10% annual interest every May 1st. And aside from that interest, the maker is also gonna pay an installment equal payment of 100,000. All right, so if the face amount of the promissory note is 300,000 and the maker or the customer will pay an equal payment of 100,000, meaning to say the life or the term of the notes receivable or the promissory note is 3 years. All right, now let's say, for example, our transaction date is on May 1st of 2020. So on May 1st of 2020, our journal entry for this sale will be debit to notes receivable for the face amount and credit to sales of 300,000 for the face amount. Now on December 31st, at the end of the year, on December 31st of 2020, at the end of the year, the accountant, and that's you, the accountant will prepare the company's financial statement. And when you prepare the financial statements, you know that this company earns an interest from this promissory note, from this interest-bearing note of 8 months. From the transaction date of May 1st up to December 31st, where you prepare the financial statement, that's 8 months. This is your financial statement date. To calculate for the interest, we take the face amount of 300,000 times 10% times 8 months. And we will come up with the interest of 20,000. And the company should recognize an interest income. So our adjusting journal entry here, since we have not received the cash for this interest income that we earned from May 1st to December 31st, we will put this 20,000 interest income that we earned on an account called accrued interest receivable. So our journal entry or adjusting journal entry will be debit to accrued of 20,000 and credit to interest income of 20,000. So on December 31st, 2020, we will recognize a 20,000 interest income. So we credit interest income, but we debit accrued interest receivable because we have not received the cash for that interest. All right, on May 1st, where we receive our first interest income, the maker will pay us from May 1st of 2020 up to May 1st of 2021, which is 12 months. So the computations of the cash that we will receive from the maker will be 300,000 times the 10% times 1 year. We will have 30,000 cash from the maker. From December 31st or January 1st of 2021 up to May 1st of 2021, we will have an interest income. So our computations of these 4 months of interest will be 300,000 times 10% times 4 over 12. And we will come up with 10,000 as interest income from January 1 to May 1st. All right, and our journal entry on May 1st, when we receive the cash for the interest, is debit to cash of 30,000 and credit to interest income of 10,000. And that's the part of the 4 months interest from January 1 to May 1st. Then we credit the accrued interest receivable of 20,000. That's our journal entry for May 1st, 2021. There's another thing that we have to make a journal entry is the payment, the first installment payment of the maker. And that is debit to cash of 100,000 and credit to the notes receivable of 100,000. On December 31st, 2020, our financial statement presentations of the notes receivable is your presentations for the notes receivable is 300,000. So that's our journal entry for May 1st, 2020. December 31st, on year December 31st of year 2021, we will again prepare for the financial statement of the company. Computation this time for May 1st up to December 31st will be 200,000 times 10%. Why 200,000? From May 1st to December 31, outstanding balance of the notes receivable is 200,000. So our interest here is 200,000 times 10% times 8 over 12. 8 over 12 is 8 months from May 1 to December 31st. Alright, and we will make another adjusting journal entry on December 31st, 2021 on our financial statement. We get 13,333 interest. So that is your interest for May 1st up to December 31st. So our adjusting journal entry will be debit to accrued and credit to interest income of 13,333. And our financial statement presentations for this year 2021, will be our notes receivable will now be 200,000. All right, 200,000 because the maker paid us 100,000 first installment. On May 1st of 2022, from January 1st of 2022 up to May 1st of 2022, we earned an interest income again, all right, for 4 months. The 8 months we already recognize that on our balance sheets or on our financial statements on 2021. Now we will receive the interest income on May 1st, the second annual interest income from the maker. And on this 4 months, the computations of that is 200,000 times 10% times 4 over 12. And we will end up with an amount 6,667. And that's your interest for the 4 months. All right, and our journal entry for May 1st of 2020, when we receive the interest, you can 200,000 times 10% is equal to 20,000, or the 13,333 that we already recognize plus the 667 that we earned for the 4 months is also equal to 20,000. All right, so our entry will be debit to cash of 20,000 and credit to interest income of 6,667. And another credit for the accrued interest receivable that we already recognized on the year 2021. For a total of 20,000, same as the cash that we receive from the maker. Another cash we receive is the second installment payment of the maker. So we debit to cash of 100,000 and credit to the notes receivable of 100,000. Now on December 31st of 2022, we will again prepare for the financial statements of the company. May 1st to December 31st will recognize an interest income. Calculations of the interest income is 100,000 times 10% times 8 over 12. Why 100,000? Our notes receivable on 2021 is 200,000 and the maker paid us 100,000. So we have an outstanding balance of 100,000. All right, on May 1st of 2022. So our basis for our interest on this is 100,000, and we come up with the interest of the amount 6,667 as our interest for the 8th month. Now, our adjusting journal entry for this December 31st of 2022 is debit to accrued interest receivable of 6,667 and credit to interest income of 6,667. Now, the financial statement presentations of your notes receivable on December 31st, 2022 is your notes receivable will then be 100,000. Now, on next May 1st of 2020, the last installment payment of the maker. So from January 1 of 2023 up to May 1st of 2023, we earned an interest income of 4 months. All right. So our basis is the outstanding balance of 100,000 times 10% times 4 over 12. The interest income that we earn from January 1 to up to May 1st of 2023, 3,333. All right, this is your interest for 4 months. The maker will pay us on May 1st, 2023, 12 months of interest from May 1st up to of 2022 to May 1st of 2023, and the basis of the interest will be the 100,000 times 10% times 1 year. So we have a cash debit to cash of 10,000, interest receivable, and credit to another interest income. All right, then we will record the last installment payment of the maker, 100,000. So we debit cash of 100,000 and credit to the notes receivable of 100,000. All right, so that is the end of your notes receivable. By this time, when we receive the last payment or last equal payment of the maker, which is 100,000, that zero out the notes receivable. The problem will not require you to do all of this, all right? I am doing this just for you to analyze from the start from the transaction date up to the maturity date. So what's going on with the accounting of this interest-bearing note? Analyze this problem. It's going to be easier for you to solve any problems on interest-bearing note. So the problem on your actual exam may ask you, for example, what is the interest of the company on December 31st, 2020? And your answer will be the 20,000. That's your interest income. All right. The problem also may ask you, what is the amount recognized on the notes receivable on December 31st, 2020? So your answer will be 300,000. The problem might also ask you some amounts that's any date on this problem. All right.